But we begin with a warning about debt. As Canadians, we've been told repeatedly that we need to kick this habit because those maxed out credit cards are putting the economy at risk of a banking crisis. The Bank for International Settlements is something of a bank for central banks. It collects and analyzes data to monitor vulnerabilities in the global financial system. They're called early warning indicators, like the amount of debt in an economy compared to economic growth, as well as borrowers' ability to pay back loans. And based on those two indicators, our banking system is among the most at risk. Only China and Hong Kong are more vulnerable. Even slow-growing economies like Italy fared better in spite of a banking system that's simply mired in bad debt. To discuss more about how Canada's banking system, along with those other countries, could be at risk, I'm joined by James Barth in Auburn, Alabama. He's a finance professor at Auburn University with a focus on financial institutions and capital markets. And break this down for us, sir, if you can. What is the BIS, the Bank for International Settlements, specifically worried about when it's raising these red flags here?
Yes, Peter. The Bank for International Settlements is worried about debt, but debt relative to GDP, that is the country's economic activity. Debt per se is not bad. It's too much debt that is bad. And what the BIS is saying is that Canada, Hong Kong, and China have too much debt relative to their economy. That's what's really bad, because then potentially, if people stop paying their debt requirements, then it turns out the economy can get into trouble and there could be a broader financial crisis.
And we've talked a lot about how that can play out for the economy at large, and especially here in Canada, where the Canadian consumers basically put our economy on their backs and carried it up this mountain over the last, whatever it is, 8 years or so, out of recession and now into pretty solid economic growth. I guess what I'd like to understand a little bit better is what is the link the BIS, the Bank for International Settlements, sees between us having too much debt and sort of structural imbalance problems within the banks and their own sort of balance sheets here?
Well, what BIS sees is that some debt is relatively good. If people borrow money and they spend it, that contributes to economic growth. So there's nothing wrong with people borrowing or going into debt because that generates economic growth, which in turn creates jobs. The problem is academic studies have shown that when the debt to GDP ratio starts to go above 80 to 100%, then countries can get into trouble and encounter a banking or a financial crisis, and in turn, perhaps even a recession. That's the concern of the BIS. They do their numbers a little bit different than some of the academic studies, but too much debt, again, is what's bad. It's not debt per se, but too much debt, right, because that is the real problem.
And it's interesting, and it's important, I think, to point out to people that it's not like the Bank for International Settlements went in and specifically looked at TD Bank or RBC to see what their sort of profit and loss estimates are. What they're looking at largely here is historical precedent, right? That what were the alarm bells that should have gone off leading up to previous crises, and extrapolating from that, what should we be looking for going forward, right?
That's exactly correct. The business basic saying there are now red flags in the countries that you mentioned, Peter, Canada, Hong Kong, and China. And these red flags are basically to tell the regulatory authorities start paying more attention to debt and make sure it doesn't grow even more rapidly relative to the size of the economy.
Let's dig then into what the countries need to do about it. I mean, China's been, every time you write about China and the economy, you write about the fact they've been de-risking, is the way they call it, since 2015. Is China taking the right steps to try to get this under control?
Well, people have been complaining about too high property prices in China for several years. China's done a really good job of trying to contain increases in property prices, actually trying to bring them down in some cities. But one of the problems that China is facing today, it has a lot of zombie state-owned enterprises. The problem is those enterprises employ people, they create jobs effectively, and those companies are reluctant to shut down or lay people off. So what China is doing is engaging what's called a debt for equity swap. They're trying to take some of the loans that those companies have and convert those loans into equity. That's what China is trying to do in the corporate sector. We don't know yet whether or not it's going to work, but it is a move in the right direction.
And here in Canada, if this report came out of nowhere and we were sort of looking at it puzzled today and said, well, what do we need to do about it? Somebody's telling me earlier today, it would be the measures we've already seen in Canada. The stress test introduced on mortgage loans, foreign buyers taxes, try to cool the housing market. Is Canada already taking some of the steps that will alleviate the concerns the BIS has?
Yes, China's already taking steps to deal with the problem. It turns out interest rates are going up, understandably, in China. That's creating some problems for people who have taken out so-called adjustable rate mortgages. But China has done things. Hong Kong is trying to do things, and Canada certainly is doing the right sorts of things. Hopefully, the economy will grow a little faster in China than what's expected right now, and that too will help deal with the debt problem.
Indeed it will. Professor, really appreciate your insight. James Barth, finance professor at Auburn University in Alabama.